Hey again, when I finished up last time, I had covered the results of the 6-month CD, one of the safest things anybody can put their money into, over the first decade of the 2000s. What we learned last time was that safety was not really what it seems to be, because in effect, the 6-month CD holder in the first decade of the 2000s lost money after inflation. And when I compared it to the sometimes maligned, sometimes made out to be the big bad stock market, it turns out that in that first decade, the stock market, as measured by the S&P 500, actually made money after inflation, after all that volatility which was so difficult to live through. And so we established that last time, and the way I ended up was whenever you look at that, it can be dangerous to have the conversation in one's mind as to, well, if it works out this way, couldn't it work out a little bit better if we timed these things, if we jumped in and out of it? And the answer is no, not unless someone gets lucky. I've referenced many times over the years through these videos and in programs that I put on about the Dalbar research results. They're one of the leading groups that tracks investor behavior and results. And they update this regularly, but the study that they had that takes the 20 years ending 2010, which is most of the same years that we're looking at on this 10-year period from last time, was that the S&P 500 outperformed the average equity investor by a little less than 6% per year. Just a remarkable outperformance of just the overall market versus what the average investor is actually getting. I hold in my hands the entire 2012 Dalbar study. There's a bunch of pages to this. I haven't counted them all. But let me just read you a couple of pieces from this, which really is the stance we've adopted on why we don't try to time markets. It says investors fail at timing the market, resulting in inflows when the market is declining, meaning the investors are investing when the markets are going down, and outflows when the market rises, which shows their data clearly shows that investors are selling out when the market increases. They go on to point out that just last September, 2011, the largest uptick in the S&P 500 occurred in September, a month when fund flows were close to zero. Close to zero. Furthermore, a couple of months later, after this uptick that happened in September, fund flows went up to 10%. They popped up, but that's when the correction hit again. So investors are notorious for doing the wrong things at the wrong time. They have actually quantified the primary reasons that they do that. I'll just refer to them briefly now, and we'll cover them at another time. But it's loss aversion, narrow framing, anchoring, making improper mental accounting, improper diversification, hurting, regret about decisions they've made, responding to the media in the wrong way, and having false optimism. So they've really quantified what these reasons are. Add it all up, it helps lead to very poor results for investors timing the markets. And it doesn't get any better when people who call themselves advisors are involved. So we'll keep unpacking this. Next time we're going to cover dividend-paying stocks. We've had a lot of questions about those. I think you'll find that interesting. Tune in next time. Thanks.